Imagine having a credit score explained in plain English. That's our goal with Credit Score 101. Your credit score is a three-digit number, ranging roughly from 300 to 850, that tells lenders how risky you might be as a borrower. In practical terms, it can determine whether you get approved for a loan or credit card and what interest rate you pay. A higher score, think 700s or 800s, means you've proven yourself financially reliable, so banks will be more eager to lend to you at favorable rates. A lower score can cost you, not just in higher interest, but sometimes in deposits for utilities or even eligibility for certain jobs. In this video, we'll demystify how a credit score is calculated by breaking down the 5 key credit score factors that make up your score, and show you how understanding these factors can help you improve your credit score over time. So, what are the 5 factors that determine your credit score? In the most common scoring model, FICO, your score is based on these components. 1. Payment history, about 35% of your score. 2. Credit utilization, amounts owed, about 30%. 3. Length of credit history, about 15%. 4. Credit mix, about 10%. 5. New credit inquiries, about 10%. A common way to visualize these is with a FICO score breakdown pie chart. The largest slice, 35%, is payment history, underscoring that your record of paying bills on time is the biggest component of your score. The next biggest slice, 30%, is your credit utilization, sometimes called amounts owed, which reflects how much debt you're carrying relative to your credit limits. Smaller slices represent the length of credit history, 15%, and equally, the last 2 factors, credit mix, 10%, and new credit, 10%. These percentages show how much each category generally contributes to a FICO credit score. Keep in mind, these weights can vary slightly depending on your personal credit profile, but this breakdown applies to most people. Now, let's dive into each of these 5 factors in detail. We'll explain what each factor means, give real-life examples of how they affect borrowers, and provide tips, with visuals along the way, on how you can manage each factor to improve your credit score. By the end of this video, Credit Score 101, 5 factors that determine your score, you'll have a clear understanding of how credit scores are calculated and what steps you can take to build or maintain a strong score. The first and most important factor in your credit score is your payment history, which accounts for roughly 35% of your score. In simple terms, payment history is your track record of paying back money you've borrowed. Lenders want to know, do you pay your bills on time? This factor looks at whether you've paid past credit accounts as agreed, that means on-time payments versus late or missed payments, and it also includes serious delinquencies like defaults, collections, or bankruptcies in your past. Think of this like your grade in a class. Consistently paying on time is like getting A's on your report card, while missing payments is like getting F's. Not surprisingly, this is the #1 factor in a credit scores calculation. It's the very first thing any lender checks. Why is payment history so critical? From a lender's perspective, past behavior is the best predictor of future behavior. If you have a strong history of paying on time, lenders feel confident you'll repay what you borrow. If your history shows late payments or defaults, that's a red flag suggesting you might miss future payments. Even one mistake can have a big impact. For example, a single 30-day late payment can knock dozens of points off your score. One analysis showed that for a person with a high credit score, approximately 780, a 30-day delinquency could lower their score by around 90 to 110 points, whereas for someone with a 680 score, it might drop about 60 to 80 points. That's huge. It means a late payment can take a great score down to merely good, or a good score down to fair. And the higher your score to begin with, the more you stand to lose from a slip-up. On the flip side, no payment problems at all on your record yields the best payoff, a solid boost to your creditworthiness in the eyes of lenders. Let's consider a real-life scenario. Visualize a calendar or payment schedule on screen. Every month that you make all your payments on time gets a green check mark. A month where you miss a payment gets a red X. If you looked at Jane's credit history and saw 2 years of green check marks, on-time payments for her credit card, car loan, and student loan, you'd predict she'll keep paying reliably. Now imagine John's history, where you spot a couple of red X's for missed payments last year. Maybe he forgot a credit card bill or struggled to pay a loan. Jane's spotless record will translate to a higher score and easier access to credit, while John's missteps will drag down his score. Payment history is essentially your credit report card. Lots of A's, on-time payments, will help your score immensely, but even one F, a missed payment, can severely hurt it. How can you excel in payment history? The golden rule is simple. Always pay at least the minimum due on time. Even if you can't pay the full balance, paying something by the due date is crucial. A payment that's 30 days late or more is what gets reported as a derogatory mark on your credit report, so avoid that at all costs. Here are some practical tips to keep your payment history clean. Set up automatic payments or reminders. Automating your payments can ensure you never accidentally miss a due date. You can also set calendar reminders a few days before bills are due. Pay at least the minimum for each account. Of course, paying in full is ideal to avoid interest, but if cash is tight, make sure to pay the minimum required. This keeps the account in good standing. If you slip up, get current ASAP. Life happens. If you do miss a payment, try to pay it and any late fees as soon as you can. Once you're current again, stay current and rebuild that on-time streak. The longer you go with no further missed payments, the less impact an old late payment will have. Consider contacting your lender if you're struggling. Sometimes, if you have a good history, a lender might forgive one late fee or not report a one-time lapse. This isn't guaranteed, but communication can help, especially before a payment is actually 30+ days overdue. On screen, you might see a graph climbing upward as you accumulate on-time payments. That's your score improving. Over time, a positive payment history will raise your credit score, making you a more attractive borrower. Bottom line, paying on time, every time, is the single best thing you can do for your credit score. It's like the foundation of a house. Get this part right, and everything else with your credit will be so much easier. After payment history, the next major factor in your credit score is credit utilization, which contributes about 30% of your score. Credit utilization, sometimes called amounts owed, measures how much of your available credit you're using. It's essentially a ratio. The total balances you owe divided by the total credit limits you have on your revolving accounts, like credit cards. This factor answers the question, how much debt are you carrying relative to your credit limits? If payment history is about whether you pay, utilization is about how much you owe. Lenders use this to gauge if you might be overextended. The logic is, if you're using a large portion of your credit, you might be at a higher risk of default because you could be relying too much on borrowed money. Imagine you have a credit card with a $10,000 limit. If you've charged a balance of $7,000, that means you've used 70% of your available credit on that card. That's a 70% utilization rate, which is quite high. Generally, using a lot of your available credit signals to lenders that you might be in some financial stress or simply living beyond your means. In contrast, if you only owe $1,000 on that $10,000 card, a 10% utilization, it appears you're managing credit responsibly and not leaning too heavily on it. Visual aid. Picture a fuel gauge or bar meter labeled credit limit used. At 10% utilization, the gauge is in the green. At 70 to 90%, it's deep in the red. High utilization can drag your score down, even if you never miss a payment, because it suggests you could be one unexpected expense away from trouble. What's considered a good utilization rate? A common rule of thumb is to keep your credit utilization below 30% of your available credit. In fact, the lower, the better. People with excellent credit scores often use less than 10% of their credit limits at any given time. Using 30% or less is viewed positively by most scoring models and lenders. Going much above that, especially consistently or on multiple accounts, can start to hurt your score. For example, if across all your credit cards you have a total credit limit of $20,000, try to keep the total balances owed under $6,000, which is 30%. If you're using $15,000 of that $20,000 limit, your overall utilization is 75%. That's a red flag to credit score algorithms, indicating you might be overextended financially. Likewise, maxing out even one card, i.e., reaching 100% utilization on that account, is bad for your score, even if your overall utilization is lower. It's important to note that credit utilization only considers revolving credit like credit cards and lines of credit. It doesn't directly count installment loans, like mortgages, auto loans, or student loans, in the percentage, because those have fixed payment schedules. However, the amount you owe on installment loans does matter in a more general sense of your debt load. For instance, having a high balance remaining on a car loan won't hurt your score the way a maxed-out credit card will, but paying down installment loans over time is generally seen as positive. That said, the revolving credit utilization is usually the key focus for this factor. Let's look at a real-life example to illustrate utilization. Suppose Maria has two credit cards. Card A has a $5,000 limit, and she carries a $4,500 balance on it, 90% utilization on that card. Card B has a $3,000 limit with a $600 balance, 20% utilization. In total, Maria's using $5,100 out of $8,000 available. Her overall utilization is about 64%, quite high, largely because Card A is almost maxed out. This high usage likely hurts Maria's credit score, even though she's making payments on time, because the scoring model sees that she's close to running out of credit. Now meet Alex, who also has two cards. Each card has a $5,000 limit. He carries a $500 balance on one, 10%, and zero balance on the other, 0%. Alex is using $500 of his $10,000 total limit. That's just 5% utilization overall. Alex's low utilization will help his score, showing he isn't relying heavily on credit. If a graphic pops up comparing them, Maria's credit utilization bar would be nearly filled, while Alex's bar would be barely a sliver. This highlights how lowering your balances can improve your credit score by reducing utilization. Tips to manage and improve credit utilization. The goal is to use credit cards, but not too much at once. Pay down your balances. This is the most direct way. If you have the means, try to pay off your credit card balances, or at least reduce them significantly, before the statement closes or before your billing cycle ends. A lower reported balance means a lower utilization on your credit report, which should boost your score. Spread out your charges or increase limits. If you have multiple cards, you can spread your purchases between them so no single card is heavily used. Alternatively, you might request a credit limit increase from your bank, but don't go on a spending spree if you get one. A higher limit with the same balance instantly lowers your utilization percentage. Just be cautious, as a credit limit increase request can sometimes involve a credit inquiry. Timing matters. Your credit report usually records your card balance at the end of the billing cycle, when your statement is generated. Even if you pay in full every month, you could appear to have high utilization if you run up a big balance that month. To combat this, you could make an extra payment right before the statement date to cut the reported balance. Avoid maxing out cards. Even if you plan to pay it off, using 100% of your credit line is viewed negatively. Try to keep each card's usage in check. If you do need to make a big purchase, say a $3,000 appliance on a card with a $3,500 limit, about 86% utilization, be aware your score might dip. Paying it off quickly will help it rebound. One myth to bust: you do not need to carry a credit card balance from month to build credit. Some people think carrying a small balance, and therefore paying interest, helps your score. It doesn't. You can pay your card in full and still reap all the credit score benefits of having the account. In fact, not carrying debt means you avoid interest charges, and your utilization will often be lower. As the Consumer Financial Protection Bureau puts it, you don't need to carry a balance on credit cards to get a good score. What matters is that the account reports on-time payments and that you use only a modest portion of your limit. By keeping your credit utilization low, ideally in the green zone, under 30%, or even under 10% if you can manage, you'll be well on your way to a healthier credit score. This factor is second only to payment history in importance, so it's a prime area to focus on if you're looking to improve your credit score quickly. Many people see score increases simply by paying down credit card balances. Your length of credit history accounts for roughly 15% of your credit score. This factor is all about time, essentially, how long you've been using credit. It considers the age of your oldest account, the age of your newest account, and the average age of all your accounts. It also looks at how long it's been since you used certain accounts. In general, a longer credit history is better for your score because it gives a more robust track record for lenders to evaluate. Think of it like a relationship. A lender knows you better if you've been using credit for 10 or 20 years versus just 1 or 2 years. There's more data to show that you're a reliable borrower, or not. Visual aid. Picture two timelines on screen, one for someone who started credit in 2020 and one for someone who started in 2000. The long timeline has many years of history, which generally signals stability, whereas the short timeline is still an unknown story in progress. However, everyone starts somewhere. If you're new to credit, you won't have a long history, and that's okay. You can still have a good credit score even with just a few years of history, especially if you nail the other factors: payment history and low utilization. In fact, the FICO scoring model is designed such that even people who haven't been using credit long can have high scores, depending on how the rest of their credit report looks. So, a short credit history is not a deal breaker. It just means you might not reach the very highest score ranges until your history lengthens. For example, many folks in their early 20s might have credit scores in the 700s after a couple of years of responsible credit use. That's a great start, even though they can't yet compete with someone in their 50s who's had 30 years of spotless credit. Over time, as you keep those accounts open and in good standing, your score will naturally get a boost from aging. What exactly goes into length of history? Let's break it down. Age of oldest account. This is the year you opened your very first credit account. If you got your first credit card in 2015, then as of 2025, that card is 10 years old. The older, the better. A long-established account is a plus. Age of newest account. This is how recently you opened your most recent account. If you just opened a new credit card last month, that's a very young account. Having very new accounts can slightly lower your average age of accounts, especially if you opened several around the same time. Average age of all accounts. This is basically the sum of the ages of each of your accounts divided by the number of accounts. It gives a big picture view of how seasoned your credit file is. For instance, if you have one card opened 10 years ago and one card opened this year, your average age is about 5 years. If you have multiple accounts, this calculation can get interesting. Opening new accounts will bring down the average age, while time passing will increase each account's age. How long since accounts were active? If you haven't used a certain credit card in a long time, it's effectively dormant. The score may consider that too. Generally, keeping accounts active, using them occasionally, can be beneficial so that they continue to count in your score. Now let's consider two examples. Alice and Bob. Alice is 25 and got her first credit card at 18, so she has 7 years of credit history. She also took out a student loan 5 years ago. Those are her two accounts. Her oldest account is 7 years, newest is 5 years, and her average age is 6 years. Not bad for a 25-year-old. Bob is 45 and opened his first credit card at 20. That's 25 years ago. He also has a mortgage he's been paying for 15 years and a car loan he got 3 years ago. Bob's oldest account is 25 years, newest is 3, and with several accounts, his average age might be around, say, 15 years. Clearly, Bob has a much longer credit history. All else being equal, Bob's long history gives him an edge in this category. Lenders have a quarter-century of data on Bob's borrowing habits, a lot more insight than they have on Alice. On screen, you might see two bar graphs or timelines comparing Alice and Bob. Bob's timeline stretches back to the 1990s, whereas Alice's starts in the 2000s and 10s. This visual highlights how much more information Bob's creditors have about him. Does this mean Alice is at a big disadvantage? Not necessarily. Remember, length of history is 15% of the score, an important factor, but not as weighty as payment history or utilization. Alice can still have an excellent credit score if she has no late payments, low utilization, etc. In fact, having a long history is not required for a good credit score. It's just something that comes with time. As long as Alice keeps up her good habits, her score will improve as her accounts age. Bob's long history helps him, but if he had a bunch of late payments, his score could actually be worse than Alice's, despite his advantage in age. Tips for maximizing length of credit history. Start early, responsibly. Simply starting your credit journey sooner gives you a head start on aging your credit. This might mean getting a beginner credit card or a credit builder loan in your name when you're young, even if it's secured by a deposit. Of course, only do this if you can use it responsibly, never to go into unnecessary debt. Keep old accounts open. One common mistake is closing your oldest credit card account. Unless there's a good reason, like a high annual fee or fraud issues, try to keep your oldest accounts open and active. Even if you don't use an old card much, maybe put a small recurring charge on it to keep it alive. The longer it stays on your report, the more it helps your length of history. Note, closed accounts can stay on your report for up to 10 years and still count toward your history during that time, but after they drop off, you lose that age contribution. Be strategic with new accounts. It's fine to open new credit when you need it, and we'll talk more about new credit in a moment, but be aware that opening several new accounts in a short period will dilute your average age of accounts. If you're planning a big loan, like a mortgage, and want to look as good as possible, it might be wise not to open any new credit cards right before that, so your average age remains higher. Patience is key. This factor will naturally improve as the years go by. There isn't a quick hack to age your credit faster, aside from possibly being an authorized user on someone else's long-standing account, which can sometimes help, but that's an advanced tactic and not necessary for most people. The best thing you can do is keep your accounts in good standing and give it time. As one piece of advice, a long credit history will help your score, and the only way to get a long history is to let the clock run while you manage credit responsibly. To sum up, length of credit history is like wine. It gets better with time. Don't be discouraged if you're relatively new to credit. Focus on the things you can control, paying on time, low balances, and know that your score will organically grow as your accounts age. If you're someone who's had credit for a long time, make sure to keep those oldest accounts healthy because they're a valuable asset to your credit profile. Your credit mix, the variety of credit types in your report, makes up roughly 10% of your credit score. This is a smaller factor, but it's still part of the scoring recipe. Credit mix refers to the different categories of credit accounts you have experience with. There are two primary types of credit: revolving credit and installment credit. Revolving credit includes things like credit cards or lines of credit, basically accounts where you can borrow up to a limit, pay back, and borrow again with no fixed end date. Installment credit includes loans that have a set amount and a fixed payment schedule, like mortgages, auto loans, student loans, or personal loans. A healthy credit mix means you have a blend of these types, for example, a couple of credit cards, revolving, and a car loan and mortgage, installment. Why does mix matter? Lenders and scoring models like to see that you can handle different kinds of credit responsibly. Each type of credit has its own challenges. Managing a credit card, with the temptation to only pay minimums and rack up debt, is different from paying a fixed loan, where the payment is the same every month. If you've proven you can juggle both, it provides a bit more confidence that you're a well-rounded borrower. It's a bit like showing versatility. Think of a student who excels in both math and literature. They're demonstrating a broader skill set. However, and this is important, credit mix is not a make or break factor. It's only 10% of your score, and you don't need to go out and get one of each type of loan just to satisfy this category. In fact, FICO itself notes, don't worry, it's not necessary to have one of each. So, do you need to have a mortgage, a car loan, a student loan, and a credit card to have a good score? Absolutely not. Many people have excellent credit scores with only credit cards and no loans, or vice versa. The mix can help at the margins. It might give you a small boost if you're already doing well in other areas. It can also become a bigger consideration if your credit file is thin. For example, if you only have one credit account total, adding a different type might help fill out your report. But if you're managing credit wisely, you won't suddenly tank your score just because you, say, don't have a mortgage. Think of credit mix as the diversity of your credit portfolio, nice to have, but focus first on the basics of paying on time and keeping debt low. Let's use an example. Sophie has 3 credit cards and no other loans. She's never had an auto loan or a mortgage, and her student loans were paid off years ago. Michael, on the other hand, has a mortgage, a car loan, a student loan, and a credit card. Michael clearly has a broader credit mix than Sophie. If both of them have similarly excellent payment histories and low utilization, Michael's mix might give him a slight scoring edge over Sophie, but not by a huge margin. Maybe Michael's score is, say, 810 and Sophie's is 795. Both are excellent, and the difference could be partly due to that mix factor. However, if Sophie opened a personal loan just to improve her mix, that new account could actually ding her score in the short term because of the new credit inquiry and reduced average age, possibly negating any benefit from the mix itself. On screen, you might see icons representing different credit types, e.g., a credit card, a car, a house, and check marks next to Michael's array of accounts, whereas Sophie has a check mark only on the credit card icon. This visual would emphasize the concept of variety in credit accounts. Tips regarding credit mix. Don't open accounts you don't need. Never take on a new loan just to diversify your credit mix. It's not worth incurring debt and interest for a minor score bump. Only get credit accounts that make sense for your financial life. For instance, if you need a car and can afford a loan, fine. That will diversify your mix. But don't randomly take out a loan or finance something you don't need. Over time, aim for a balance. You might find as you go through life that you naturally acquire a mix. Perhaps a couple of credit cards, maybe a mortgage when you buy a home, an auto loan if you get a car, etc. That organic mix is sufficient. Again, you do not need every type. If you're missing one category, say you rent so you have no mortgage, or you never had student loans, that's okay. If you only have loans, consider a credit card, and vice versa. Some people avoid credit cards entirely and only have loans, but having at least one credit card can be helpful to build credit history and show you can manage revolving credit. Conversely, if you've only ever had credit cards, someday using an installment loan, when needed, like for a car or home, will add to your mix. Don't fear credit cards if used wisely. A no annual fee card paid in full monthly can actually boost your credit profile. And don't fear loans if they're necessary and affordable, just pay them on time. The impact is small. Remember that credit mix is a minor factor. So if you're a newbie with just one secured credit card right now, Don't stress about it. Focus on growing your history and keeping that card in good standing. You can add other types of credit down the road when it makes sense for you. In summary, credit mix adds a bit of flavor to your credit score. Lenders like to see it, but it's like the icing on the cake. The cake itself is your payment history and debt levels. If you happen to have a diverse set of credit accounts, great. You're showing you can handle various responsibilities. If not, don't worry. You can still have a high score. Use credit wisely in whatever forms you need, and your mix will take care of itself over time. The last of the 5 factors is new credit, accounting for roughly 10% of your score. New credit refers to recent activity of opening accounts or applying for credit. When you apply for a loan or credit card, the lender usually performs a hard inquiry on your credit report, basically a record that they checked your credit because you requested new credit. These credit inquiries and newly opened accounts can temporarily ding your score. The credit score formula is asking, are you taking on a lot of new debt recently? If you are, it could be a sign of financial trouble or overextension, so the score taps the brakes a bit. Research shows that opening several credit accounts in a short period of time represents a greater risk to lenders, especially if you don't have a long credit history to start with. That's why this factor exists. Here's how it works. Every time you formally apply for credit and a hard inquiry is logged, your score might drop a few points. One inquiry is not a big deal. Maybe your score drops 3 to 5 points temporarily. The impact of a single inquiry fades over time. Typically, its effect on your score disappears after 12 months, and the inquiry record itself drops off your report after 24 months. However, if you start applying for multiple credit cards and loans in a short span, those inquiries can add up. For example, 5 new applications in 2 months could take, say, 20 to 25 points off your score in the short term. And, more importantly, it signals to lenders that you might be desperate for credit or about to rack up a lot of debt. Visualize a warning light on a dashboard. One blip, inquiry, doesn't cause alarm, but a rapid series of blips makes the light flash more urgently. In a graphic, you might see a score meter dip slightly with one inquiry, and dip more with each additional one in a cluster. Another aspect is new accounts. When you open a brand new credit account, it can actually have a small negative effect at first. This is because it's an unknown. There's no payment history on it yet. It reduces your average account age, hurting the length of history factor a bit. And statistically, new accounts are more likely to default than seasoned ones, since if someone is going to get in over their head, it's often right after taking on new debt. Over time, if you manage the new account well, it becomes a positive contributor. But initially, a flurry of new accounts is a risk factor. It's like a person taking on a bunch of new responsibilities all at once. Will they be able to handle it? Lenders prefer to see that you can handle what you already have before adding more. Let's illustrate with a story. Meet Kevin. Kevin decided he wants to spruce up his financial life and gets a bit overzealous. In the span of 1 month, he applies for a new credit card, a personal loan, and a store credit line to finance some furniture. That's 3 separate credit inquiries, and eventually 3 new accounts if all are approved. When the credit card inquiry hit, Kevin's score dropped a tad. Not much, maybe 5 points. Then the personal loan inquiry and new account knocked it down another handful of points. Then the store credit line did a bit more. Individually, each action wasn't severe, but combined, Kevin's credit score might have dropped, say, from 720 to 680 due to this burst of activity. Moreover, to a lender or scoring model, Kevin appears riskier. Why is he suddenly needing so much credit? It could be a life change or an emergency, but it could also mean he's in a financial bind. Now meet Lisa. She applies for credit very sparingly. Maybe 1 year she opens a new credit card for rewards, and a couple of years later she gets an auto loan for a car. Lisa's inquiries are spaced out by a year or more, and she doesn't look like she's scrambling for credit. Her score might dip a few points after an application, but it bounces back within months as she proves she can handle the new credit. In a visual, you might see Kevin's scoreline taking a quick dip with multiple inquiry markers close together, whereas Lisa's scoreline has an isolated tiny dip once in a while, quickly recovering. This shows why applying for a lot of credit in a short time can hurt your score, while moderate, infrequent applications won't do lasting damage. Key points about new credit and inquiries. Hard inquiries versus soft inquiries. Only hard inquiries, when you apply for new credit, affect your score. Soft inquiries, like checking your own score or pre-approved offers, do not impact your credit score at all. So you can check your own credit report or score as often as you want without fear. It's smart to monitor it. Shopping for rates. The scoring models understand that when you're rate shopping for a big loan, mortgage, auto loan, student loan, you might have multiple inquiries as you apply to different lenders. To accommodate this, inquiries for the same type of loan within a certain window, usually 14 to 45 days depending on the scoring model, often count as one inquiry for scoring purposes. For example, if you have 5 car loan inquiries within 2 weeks, it generally won't quintuple the damage. It'll be treated more like one instance of shopping for a car loan. The idea is to let consumers find the best rate without being penalized for each check. Note: credit card inquiries, however, each count separately because people don't traditionally rate shop for credit cards in the same way. Time heals this wound. The effect of new credit is front-loaded. As months go by without additional inquiries, your score will gradually rebound. After a year, most of an inquiry's effect is gone. After 2 years, inquiries vanish from your report entirely. So if you applied a lot last year, just be patient and avoid new inquiries this year. Your score will likely improve as those old inquiries age off. New accounts need time to settle. When you do open a new account, keep an eye on your credit score. You might see a small initial drop, but as you make on-time payments on that account and keep the balance in check, it will start contributing positively. It usually takes about 3 to 6 months of history on a new account for its presence to be neutral or positive for your score. During that time, don't panic if your score is a bit lower. It's normal. Be strategic with applications. If you're planning a major loan, like a mortgage soon, avoid opening new credit right beforehand. Similarly, if you're rebuilding credit, try not to apply for too many things at once. Instead, pick one starter card or loan, use it well, then maybe add another after a year if needed. Tips to manage new credit wisely. Only apply for credit you truly need or carefully plan. Each application can shave a few points off your score, so don't scatter applications everywhere on a whim. Do your research first. For example, if you want a new credit card, compare options and pick one that you have good odds of being approved for, so you don't waste inquiries on denials. Space out your credit applications. A good rule is to try to wait at least 6 months between credit card applications, if not longer. For bigger loans, those are situational. You don't take out a car loan or mortgage often, ideally. If you apply for something and get approved, give your credit time to recover before the next application. Plan around life events. If you know you'll need a mortgage next year, maybe hold off on that new credit card or car purchase until after your home loan is secured. Lenders get skittish if they see you opening new accounts during the underwriting process for a big loan. Don't fear an occasional inquiry. While we're cautioning against too many, remember that using credit is necessary to build credit. It's totally fine to apply for credit once in a while. If you've avoided all credit inquiries for years, you might be unnecessarily depriving yourself of opportunities or better rates. For instance, a great credit card with rewards or a needed home improvement loan could be worth the small temporary score dip. The key is moderation. In summary, new credit and inquiries are like the burst factor of your credit profile. A burst of new activity can have a short-term negative effect and make lenders wonder what's up. But as long as you apply for credit judiciously and manage any new accounts responsibly, this factor will not hurt you in the long run. It's mostly about avoiding the appearance of financial instability. Keep your new credit requests thoughtful and spaced out, and you'll be fine on this front. We've now covered the 5 factors that determine your credit score. Let's quickly recap them. 1. Payment history, 35%. Your record of on-time payments, or any late payments. This is the most important factor. To keep it strong, always pay your bills on time, and if you've had missteps, get current and stay current. This is the foundation of a good credit score. 2. Credit utilization, 30%. How much of your available credit you're using. Keep balances low relative to limits. Aim for usage under 30% or even under 10% if possible. This shows you're not overextended and can manage debt wisely. 3. Length of credit history, 15%. How long you've been using credit. A longer history generally helps your score. You can't fast forward time, but you can start building credit early, keep old accounts open, and be patient. 4. Credit mix, 10%. The variety of credit types you have, credit cards, loans, etc. It's a smaller factor. You don't need every type of account, but having a mix, eventually, can give your score a slight boost. Focus on handling whichever types of credit you do have responsibly. 5. New credit, 10%. Recent applications for credit and new accounts. Too many new credit inquiries in a short time can temporarily lower your score and worry lenders. Apply in moderation and only as needed. Space out credit requests to show stability. Understanding this FICO score breakdown is empowering. These 5 factors are like the ingredients in your credit score recipe. Now that you know the recipe, you can manage what you add to it. The 2 biggest ingredients, payment history and utilization, are where you should concentrate your efforts for the largest impact on your score. Pay on time, keep your debts low, and you've already mastered 65% of what makes up a credit score. The remaining factors, history length, mix, new credit, fine-tune your score, handle them smartly, and you'll maximize your credit potential. If your goal is to improve your credit score, use these factors as your roadmap. For example, if you find your utilization is high, make a plan to pay down balances. If you've been late on payments before, commit to never missing one going forward. Perhaps set up those automatic payments or reminders. If you're new to credit or rebuilding, consider products like a secured credit card or credit builder loan to get started. Just 1 or 2 accounts, you don't need many. Over time, as you demonstrate good habits, your score will rise. Improving a credit score is a bit like getting in shape. You won't see drastic changes overnight, but steady, responsible actions month after month will lead to significant improvement over time. Before we wrap up, remember that knowledge is power. Regularly check your credit reports. You can get them free annually from each bureau to ensure everything is accurate. Mistakes on your report, like a payment mistakenly marked late when you paid on time, can hurt your score unfairly. If you spot one, you have the right to dispute it and get it corrected. Monitoring your credit also helps you track your progress as you implement these good habits. And don't be discouraged by setbacks. Credit scores can fluctuate, but if you stay focused on the core principles, pay on time, use credit sparingly, and only borrow what you can afford, you will see positive trends. In closing, Credit Score 101 comes down to this: pay responsibly, borrow responsibly, and time will do the rest. A good credit score opens doors, easier approval for loans and credit cards, better interest rates, saving you money, and even opportunities like renting apartments or getting certain jobs with less hassle. By mastering the 5 factors of credit scores, you're taking control of your financial future. We hope this breakdown of how credit scores are calculated has cleared up the mystery and given you concrete steps to manage your own score. Thank you for joining us in this deep dive into credit score factors and how to leverage them to your advantage. With this knowledge, you're well equipped to build and maintain a strong credit score. Remember, it's not about gaming the system or quick fixes. It's about consistent, good financial habits. Keep those up and the score will take care of itself. rewarding you with the benefits of excellent credit. Now you have the tools to improve your credit score and keep it shining. Happy credit building.